Hi, this is Nashimar, the CEO of InfoTechSquad.com and the Gleim-led professor. I encourage students and professionals to sign up with Gleim to enhance their knowledge. I also request to those who watch our videos to subscribe with our channel to receive the most up-to-date videos regarding the taxation in their email on time. Why should you subscribe our channel? We are the team of EAs and CPAs, and we develop content based on the IRS publications and the Congress sections. My today's topic is about what is the difference between standard deductions and itemized deduction. Let's start with the definition. To calculate taxable income, you must subtract either itemized deduction or the standard deduction, depending on which one is greater, from adjusted gross income (AGI). The below the line deduction, also known as Schedule A. The below the line deductions play a crucial role in lowering the taxable income and overall tax liability. Now let's find out what are the characteristics of the standard deduction. There are different types of deductions based on the filing status. I'm going to share each standard deduction based on the filing status. If you are single or married, you can file separately and your standard deductions are $14,600. If you are filing jointly, as a married filers, your standard deductions are $29,200. If you are filing head of household, your standard deductions are $21,900. All these deductions change every year based on the inflation. So these are the deductions what I have just shared with you. Those are for 2024. Lowering tax liability can be achieved through these deductions. More standard deduction, less liability. If the taxpayer is blind or 65 years old, the standard deduction goes up by number one, $1,550 for married couples filing jointly and married couples filing separately. Number two, head of household and single status are both eligible, $1,950. If you are married and over 65, so your standard deductions are $29,200, and if you are, then you will also have, in addition to $29,200, $1,550 for married couple filing jointly and married couples filing separately. Same as for the head of household. Head of household standard deductions are $21,900. If you are blind and over 65, you will have an additional deduction of $1,950. Again, these are all the deductions related to 2024. Now let's talk about the dependent. If a person is claimed a dependent on someone's return, so how much standard deductions are allowed? Dependents have a standard deduction of either $1,300 or the total of their earned income along with $450. However, it cannot exceed the standard deduction for single filer, which is $14,600 for 2024. To assist comprehending the application of the standard deduction, here is an example. Let me explain it with an example. Claire, a single taxpayer, files an income tax return in 2024. Compute her standard deduction if he is 67 years old on December 31st, 2024. Again, there is an example to understand about the standard deduction, how it is computed. Claire, a single taxpayer, files an income tax return in 2024. Compute her standard deduction if she is 67 years old on December 31st, 2024. Explanation. Claire will be eligible for an extra standard deduction when she turns 65 on December 31st, 2024. For 2024, the single filer's total standard deduction will increase $16,550 by adding $1,950 to the standard deduction of $14,600. Here is another example with the same data of the example 1. In accordance with the previous example, Claire has son who is dependent on her. His name is Will. Calculate Will's standard deduction if he earns $700. Now Claire, before in the previous example, she filed single. Now here she has a son, so it will be based on the head of household. So in accordance with the previous example, Claire has son who is dependent on her. His name is Will. Calculate the Will standard deduction if he earns $700. So standard deductions are $1,300. His earned income is $700 plus $400, $1,150. So now we have to compare his earned income plus $450, so total $1,150 with the standard deduction, and whichever is greater, we'll consider the dependent's standard deduction. So in this case, $1,300 is greater than $1,150. Therefore, Will's deductions will be standard deduction will be $1,300. Okay, now if your taxable income is higher than the standard deduction, before I was explaining the standard deductions. Now I'm comparing it with the itemized deduction. Then we'll also compare itemized deduction with the bunching itemized deduction. So let's start with the characteristics of the itemized deduction. In your taxable income is higher than the standard deduction, itemized deductions can be particularly advantageous. Basically, let me give you here a tax tip, or when you are especially doing your education. This is particular for the students. When you study about the tax return, so it is all about the revenues minus how much expenses you can claim and what credits are available to claim to reduce the liability. As much as liability legally you can reduce, the taxpayer will pay the least taxes. So based on this one, so itemized deduction and standard deduction are also the elements of reducing income. Now let's go back to what we are doing about the characteristics of the itemized deduction. If your taxable income is higher than standard deduction, itemized deduction can be particularly advantageous. Generally, we use this type of itemized deduction, which I'm going to share with you one by one. If your AGI or adjusted gross income exceeds 7.5%, you can deduct medical and dental expenses. Number 2, up to $10,000 is the maximum amount of state and local taxes, which includes property and income taxes. Number 3, up to $750,000 in loans can be eligible for mortgage interest. Number 4, for donations that meet the criteria, charitable contributions are available. Number 5, losses from casualty and theft areas where disaster have been declared by the government. So again, losses from casualty and theft. Losses from casualty and theft in areas where disaster have been declared by the government. These are all the itemized deduction what I'm sharing with you. Number 6, the investment interest expense is the interest paid on borrowed money to purchase taxable investment. Number 7, the difference between standard and itemized deduction is determined by the one that provides a large reduction in taxable income. The taxpayer benefits from itemized deduction only when they exceed the standard deduction in total. So basically, whichever is higher will use, if the standard deductions are higher, will use a standard deduction in order to reduce the liability. Otherwise, will use the itemized deduction. The taxpayer benefit from itemized deductions only when they exceed the standard deduction in total. There are some taxpayers who find themselves in a situation where their itemized deductions consistently exceed the amount of their standard deduction, resulting in little or no tax benefit. If your standard deductions are better, then you should use the standard rather than the itemized deduction. To make tax planning more effective, the cash basis taxpayer can combine itemized deduction in 1 year to surpass the standard deduction. The standard deduction can still be used by the taxpayer in non-bunched years. The standard deductions can be used as an effective tax planning strategy if itemized deductions are close to it each year. So basically, you can always switch over from, like, if 2023 you use itemized, in 2024 you can use standard, and later year accordingly, whichever is you better benefit, you can use either. Now there is another item which is called itemized bunching deduction. This is one of the elements of itemized bunching deduction. So basically, when you apply itemized, so you have to compare with the itemized deduction with the itemized bunching deduction, and you have to take whichever is better. Itemized bunching deduction is a taxpayer strategy where you group multiple years worth of deductible expenses into a single tax year to exceed the standard deduction and maximize your itemized deduction. If your itemized deductions are within the standard deduction amount, this can be especially helpful. Let's assume that the standard deduction for sale. Let me explain it with you with an example. Let's assume that the standard deduction for a single individual is $13,850. Normally, individuals can have $4,000 in charitable donation, $3,000 medical expenses, and $2,000 in property taxes annually. Total $9,000, which is below the standard deduction. By incorporating the bunching strategy, you can double your charitable donation to $8,000, $4,000 multiplied by $8,000, and pay your other expenses like property taxes and medical expenses simultaneously, resulting in a total of $13,000. By doing this, you can exceed the standard deduction and categorize your deduction for the year. In the upcoming years, you will be using the standard deduction instead. So you have to compare which is better, bunching or regular itemized. The primary benefit of bunching. So what is the benefit? Why should we use, or taxpayer use, the bunching rather than a regular itemized? The primary benefit of bunching itemized deduction is that it can help you maximizing your tax saving by pushing your itemized deduction above the standard deduction threshold in a given year. This could lead to decreased taxable income and consequently a decreased tax bill. Moreover, bunching can offer flexibility of charitable giving in strategic financial planning. Bunching itemized deduction is an acceptable tax strategy by the law. It is legal by the IRS. It is crucial to comply with all relevant laws and regulations, including the deadlines of payments and the types of expenses that qualify for itemized deduction. If you want to report bundle itemized deduction on your tax return, take these steps. Gather evidence. Gather all receipts and reports of your deductible expenses for the year in question. Complete Schedule A by utilizing Form 1040 Schedule A to list your deductions. Compile a list of all your deductible expenses, including medical expenses, charitable contribution, and property taxes. Determine the standard deduction for your filing status by comparing your total itemized deductions to the standard deduction. If your itemized deduction exceeds a certain amount, you have the option to list them on Schedule A. Complete your tax return and attach Schedule A for submission. Let me give you a quick brief what we have covered in this chapter. Basically, this chapter was about the difference between the standard deduction and the itemized deduction. Whichever is higher, you can claim that one to reduce your liability. So, standard deduction for married filing jointly was $29,200. For single or married filing separately was $14,600. For head of household was $21,900. And there was an additional standard deduction if you are over 60 or blind, $1,550 for married couple filing and married couple filing separately, and for household and single, $1,950. We also covered how much should be the dependent standard deduction if he is claimed. So we have to compare with the standard deduction, which is 1,300 versus or with the earned income 700, whatever the earned income was, plus 500, but 4 plus 450. But it cannot be exceeded with the regular standard deduction. Then we covered with the characteristics of the itemized deduction, and there is a new topic of the which is not common for most of the people. So it's very important to share your colleagues, your other professionals, so that they are also aware about the punching itemized deduction. I hope you would have enjoyed, and I'm sure I have shared something which is knowledgeable for you and which you can apply in your education and your profession. I thank you and God bless you.